On July 4th, 2025, President Trump signed groundbreaking tax legislation known as the One Big Beautiful Bill that will fundamentally change how millions of Americans file their taxes. This historic law introduces three significant tax deductions specifically designed to benefit working-class Americans who have been struggling with rising costs and economic pressures. The legislation, officially designated as Public Law 119/21, represents the most substantial tax relief package for middle-income earners in over a decade. Unlike previous tax reforms that primarily benefited high-income earners and corporations, this bill directly targets workers in the service industry, those putting in overtime hours, and seniors who continue working past traditional retirement age. What makes these changes particularly significant is their immediate impact and accessibility. These aren't complex loopholes that require expensive tax attorneys to navigate. Instead, they're straightforward deductions that ordinary working Americans can claim on their tax returns starting with the 2025 tax year, which they'll file in early 2026. The first and perhaps most talked about provision eliminates federal income tax on up to $25,000 in tip income annually. This change affects millions of Americans working in restaurants, hotels, salons, casinos, ride-sharing services, and countless other service industries where tips form a substantial portion of workers' income. For decades, tipped workers have faced a unique burden in the American tax system. While their base wages often fall below minimum wage due to tip credit provisions, they've still been required to pay full federal income taxes on every dollar they earn in tips. This new law changes that fundamental inequity by allowing workers to deduct qualified tip income from their federal tax liability. The eligibility requirements are relatively straightforward but important to understand. Workers must be employed in occupations that customarily and regularly receive tips, a definition that the IRS will clarify with an official list by October 2, 2025. The tips must be received directly from customers or through legitimate tip-sharing arrangements with coworkers. However, there are important limitations. Self-employed individuals working in specified service businesses such as legal, medical, or financial consulting cannot claim this deduction. The legislation specifically targets traditional service industry workers rather than high-income professionals who might occasionally receive gratuities. Income limits also apply, with the deduction beginning to phase out for individuals earning more than $150,000 annually or couples earning more than $300,000. The phase-out occurs gradually, reducing the available deduction by 10% for every $1,000 earned above these thresholds. This means that even workers earning slightly above the limits can still benefit from partial deductions. It's crucial to understand that this provision only affects federal income taxes. Workers will still owe payroll taxes for Social Security and Medicare on their tip income, as these programs depend on comprehensive wage reporting for future benefit calculations. Additionally, state income taxes will still apply unless individual states pass conforming legislation. The second major provision addresses overtime compensation, introducing the first-ever federal tax break specifically for workers who put in extra hours. This no tax on overtime rule allows workers to deduct the premium portion of their overtime pay from their federal taxable income. Under the Fair Labor Standards Act, overtime is typically calculated at 1.5 times a worker's regular hourly rate for hours worked beyond 40 in a week. The new tax provision allows workers to deduct the premium portion that extra 50% above their regular rate from their taxable income. For example, if someone normally earns $20 per hour but receives $30 per hour for overtime work, they can deduct the $10 premium from their taxes while still paying taxes on the base $20. The deduction caps are generous. Individual filers can deduct up to $12,500 in overtime premiums annually, while married couples filing jointly can deduct up to $25,000. This represents a substantial benefit for workers who regularly put in extra hours to make ends meet or achieve financial goals. The same income phase-out rules apply as with the tip provision. Workers earning more than $150,000 annually will see their available deduction reduced by 10% for every $1,000 above the threshold. However, given that workers earning this much are less likely to depend heavily on overtime pay, the vast majority of overtime workers should qualify for the full deduction. This provision recognizes the reality that overtime work often represents significant personal sacrifice. Workers giving up time with family, missing social events, or pushing their physical limits to earn extra money shouldn't be penalized at tax time for their dedication and hard work. The third provision acknowledges a growing reality in American society. Millions of people over 65 continue working, either by choice or necessity. The Senior Work Bonus provides a $6,000 above-the-line deduction for working Americans aged 65 and older, recognizing both their continued economic contribution and the unique challenges they face. This deduction applies regardless of work schedule, whether someone works full-time, part-time, or seasonally. The only requirement is having earned income and reaching age 65 by December 31 of the tax year. For married couples where both spouses qualify, the total deduction doubles to $12,000. The income limits for this provision are more restrictive, reflecting the reality that many seniors have additional income from pensions, Social Security, and investments. The deduction begins phasing out at $75,000 for single filers and $150,000 for couples, with a gentler phase-out rate of 6% per $1,000 over the limit. This provision serves multiple purposes beyond simple tax relief. It encourages seniors to remain economically active if they choose, potentially reducing strain on Social Security and Medicare systems while allowing older Americans to maintain financial independence and social engagement through work. All three deductions take effect for the 2025 tax year, meaning they apply to income earned starting January 1, 2025. However, workers won't actually claim these deductions until filing their taxes in early 2026. The window of opportunity is limited. These provisions expire after December 31, 2028, creating just 4 years of benefits. This timeline creates both opportunity and urgency. Workers who want to maximize their benefits need to start preparing immediately. For tipped workers, this means maintaining detailed daily logs of all tip income, whether received in cash, added to credit cards, or distributed through tip pooling arrangements. The records should include dates, amounts, and the source of tips. Overtime workers need to track their regular hours, overtime hours, base pay rates, and overtime rates. While employers will be required to report qualified overtime compensation on W-2 forms, maintaining personal records provides backup documentation and helps workers verify their employer's reporting accuracy. All workers claiming these deductions must include valid Social Security numbers on their tax returns. Married couples must file jointly to claim the full deduction amounts. Filing separately significantly reduces or eliminates these benefits. The potential savings from these deductions are substantial. A restaurant server earning $20,000 annually in tips could save approximately $3,000 in federal taxes. A factory worker earning $5,000 in overtime premiums could save around $750. A working senior claiming the full $6,000 deduction could save $900 to $15 depending on their tax bracket. However, these savings only materialize with proper preparation and filing. Workers should begin tracking their qualifying income immediately, communicate with employers about proper reporting, and consult with tax preparers familiar with these new provisions. The One Big Beautiful Bill represents a fundamental shift in tax policy, directly benefiting the Americans who form the backbone of our economy. For the first time in decades, major tax legislation specifically targets working-class Americans rather than corporations or high earners. The question isn't whether you can afford to take advantage of these provisions, it's whether you can afford not to. With proper planning and record-keeping, these deductions could put hundreds or thousands of dollars back in your pocket over the next 4 years.